Welcome back to another video. And in this video, we're going to talk a little bit about Chapter 4 and the demand for assets. And the assets we're referring to either bonds, and it's from the perspective of the saver, whether it's a stock or it's a bond, why would we invest at all? So what is the determining factors of why we would invest in a particular instrument, whether it's a bond or if it's savings account or a CD or a stock? Why would we even bother putting our money into something like that? Well, I know that we talked about in the previous chapter and previous videos, we talked about rate of returns, and that's what part of what we're going to talk about here in determining the asset. Well, first we want to see the four parts of that are measured, or the four qualities of an asset to determine whether we would invest or not. One is wealth. How fast will that grow? And in that growth, will there be some value to it in the future? If there's a future value we're expecting, not the number, but that there is a value to it, a real value that we are expecting, then that means that we're going to be growing in size, wealth, there's growth. A second factor would be our expected return, how fast or how quickly that is going to grow. Again, that expected return actually is not merely a number, but it's a valuation of what we want. And if the investment meets that qualification, that is individualized, it's based on consumer or saver's preference. And in this case, we're talking about a preference of the amount of return, or how much that wealth, how much that asset's going to grow. And the other is risk. There is the ever famous risk return valuation thought process. The higher the risk, the higher return. The lower the risk, the lower the return. Yes, but if you're only looking at the risk factor, then the return, or you are focusing on the return factors, then you're really not measuring the asset properly. There's more to it than just risk and return. There's, again, the growth and how much risk are you willing to take? We'll talk about in a second. And the other is liquidity. How quickly can you now turn that into cash? Liquidity is how quickly an asset can be turned into cash. And if there's no loss of wealth or loss due to that, or some cost, based on the cost of converting from the asset to cash, which is an asset, but cash is liquid, it's spendable. You can't spend a bond. You can't go to the grocery store and say, here's my groceries and here's a bond, I'm going to take it out. No, they're not going to take that. They'll take your card, they'll take your cash, but the credit card is a liability, your cash is an asset. And your deposits in a bank are considered assets too, in that they're your deposits of a checking account or savings account. As a saver, you're going to put it in the bank. That's an asset too, and that's a cash equivalent. So cash or cash equivalents are an asset. Stocks, investment, marketable securities, bonds, mutual funds, these are all assets, but they are less liquid. It takes time to turn them into cash. How quickly can you turn it into cash in the necessity that you need cash quickly? That is also a factor we won't talk into this chapter too much. Just again, these are valuations, these are values or weights on determining the quality of the asset or their demand. The higher demand would be where it was the stability is high. There might be a rate of return that's high with a high risk. The reason why the risk and return are higher is because demand for the other parts are going to be very, very low. Maybe it's very illiquid with an IL, illiquid meaning that it's less liquid or less propensity to become cash, or that it doesn't grow very fast, which if it's got a high return, it's probably growing very fast. So let's talk about valuing our expectation of return versus the actual return, or the probability. Now we're going to talk about probability a little bit. No, I'm not talking about stats and probability. You're not going to create the probability on it. You're not going to use all those functions, but we're going to apply probability to valuing and to the value of this the value of the asset. So if we look at the expected return, that's what that little e stands for, is expectation of this expected return. We look at the probabilities of each of the returns that are stated. Each return has a probability of happening. 1 year or in the last 5 years, the return was X amount, but in 2 years it's been Y amount. So if you look at 5 plus 2 is 7, then 5/7 of the time it was at this rate, 2/7 of the time it was this amount. So now we have to weigh the probability against the rate of return, because it's not probable every year. It's going to be, there's a probability of happening. If it's happened more often, then there's a higher probability of it happening. So we have to weigh the return for each of these returns, percentages, by the percent of the probability. And so all the probabilities add up to 1, obviously. And so we're going to multiply the probability by the return, and that would be one factor. Then we do it for another return, and we do it so on, adding it to the number till nth number of returns and probabilities. That's why I added the Rn over here, to show that we're talking about, it could be more than 1, it could be, it could be more than 2, it could be 3 or 4. So you want to get that probability and weigh the return by the probability of that return happening. You see, so it's not 100% going to happen all the time. There's a fraction of the time that it will happen this way, so we're going to reduce that expectation that it will still happen. Now that all together, when we add all those weighted returns together, we get what we call an expectation of return. It's an expectation, it's a weighted average expectation of return. This is basically weighing the averages. It's a weighted average. It's weighed by the probability that that particular return is going to happen. Now, that's well and good. That'll tell us that we should expect this. But now let's find out how much of a range, or how far apart the returns are from each other in relation to the rate of return, or that weighted average. How much more are each, or how much less are each of these returns in relation to the expectation, or that weighted average of the return, the weighted average or expectation of risk. So we're going to look at the standard deviation. We're going to throw that in there too. So we're starting off with, we're adding back in the standard deviation. And so the standard deviation combined with the rate of return, or expected return, will give us a wider, or a more fuller explanation or understanding of that asset. So we go back to what we have already, is the probability and the rate of return. And so what we're doing here, inside here, is we're looking at the range, or the mini range, or the distance from how far apart the various rates of return that we've seen in the past, how it relates to that weighted average. So, and we take the square of that and multiply that squared number by the probability of that particular return. It's this return sub 1 and the probability sub 1. And we do it again. We take that rate of return, the second one, minus the expectation, and then we square that and multiply that. And each of those factors, each one of those is squared and multiplied by the probability. So it's again weighed, but the weight is against the range, or the distance from expectation, or that weighted average, versus just the return itself. So we're weighing it a second way, but it's even smaller. And when we add those up together, and this last factor here is the probability of the nth return times the nth return minus the expectation, or expected return, squared. And then we're going to take the square root of that entire thing, and that's what we're going to come up with our standard deviation, from the deviation from the expectation of the weighted average expected return. The weighted average expected return. That is the standard deviation we're looking at, how far away everything is coming from, whether it's above or below that weighted average. And if the standard deviation is high, then the risk is high. So we may have a high expected return, but we're also having a risk. Now we've weighed the risk, and now we can weigh the risk between one and another. And that's where it comes in with the individual's choice. Individual choice will determine whether an individual is risk averse or risk seeking. The risk seeker is the one who is going to look for the higher risk for the higher return. And the risk averse is the one that wants the safe bet, the safe saver, versus the spending saver. The spending saver meaning that they're spending time to look for and searching for that high risk, high return asset. But you have the safe saver who is looking for, who is have a more of an adversity to the risk. All that is part and parcel to determining expected risk, expected return, and the risk that we're expecting from the asset. The higher the risk, the higher return. If you're a risk seeker, you're going to pay for, you're willing to buy that. So you have a higher demand for that. You're also individually, if you're a risk averse and it's a high return, high risk, you're going to have a less demand for it. You may still have some. And that's individual investor saver choice. And that choice will help us determine what the supply and demand for assets will be further on. So these are your determinants and how that may shift the demand and supply curves in the market. Now we're going to get into, in the next video, we're going to get into a little economics in a micro sense. We're going to look at a market, particular asset market. Welcome to another video. We're continuing on with chapter 4, and I want to talk a little bit about the economics, specifically microeconomics, surrounding asset demand and asset supply. We found some of the determinations or the valuation points with wealth, expected return, the level of risk and liquidity, and how much an individual saver will want to invest, or what the propensity, depending on their risk aversion versus risk seeking, as their expectation of, of their, how much risk they're willing to take on, and to determine what their individual demands are. And when we combine those demands and through the self-interest of the markets, we determine that there will be certain people that will demand a bond or a stock at certain prices at a certain amount. So we have certain levels. We do this in micro. We do a market survey, but we can also do it through just trial and error, and past performance is indicative in certain respects of future performance, not in the valuation or in return, but in the predicting of how much at what particular price we're going to get or sell. And so the book actually, and the slides actually come up with a way of determining that. It's a bit arbitrary, just for demonstration purposes, a bit arbitrary, but nonetheless, we can see how this works in a normal fashion. But suffice it to say that we can determine or derive the demand curve based on individual savers and individual spenders with their level of supply and demand, how many they're willing to supply, how many at that particular price. And here is a derivation, a very similar derivation that you would see in any textbook when it relates to bonds or other assets. And the demand, again, is derived by the number of bonds purchased at certain prices. Now, I have two different axes here versus your typical, if you remember back in micro, there was only one that was price and quantity demanded or quantity supplied or quantity on the x-axis and the y-axis. But I have two because there is a relationship between the price and the interest rate or the rate of return, not expected, but the rate of return of that investment. So and the left y-axis over here, the left vertical axis here is the price of a bond. I'm going to focus on bonds a little bit. The price of a bond with the highest price on the top and the lowest price on the bottom. On the other side here, the other vertical axis is interest, where interest is high on the bottom and low on the top. If the interest rate is low, if it's high, there'll be a higher amount of quantity demanded. You're going to want more because your rate of return is going to be higher, but there'll be fewer, so the quantity would be higher. But if it's a lower interest rate, then suppliers in this case are spenders or borrowers are willing to borrow more if the interest rate's lower. You'd pay less if there was lower interest rates. So that's the relationship here. And if it's a higher price, or if the price is low, I'm not willing to supply, whereas buyers are willing to pay less for a higher price. Prices are low, prices are high. That's the difference. So the equilibrium point right here, this point right here is called equilibrium. That's where, generally speaking, the demanders of bonds are willing to buy a bond at that price, and that rate of return, or that particular interest rate, and suppliers are willing to sell at that price and will pay that interest rate. So that's equilibrium. Now, if the price of the bond starts to go up, where equilibrium here, what we have here is if this price goes up, allow me to demonstrate. If the price happens to be here, you notice that it's north of equilibrium. This portion right here is called excess supply. In an excess supply, the price has to drop down to meet the demand, which is much lower. You see, much lower at that price. If the price was lower, we're at excess demand, where the price is so low, there's more people wanting to buy it than there is available at that lower price, so the price will have to go up. And these determinants of whether it's an excess demand or an excess supply is determined by, again, the individual and the market. So the market price becomes lower, then the market price will have to move to meet that demand if the suppliers aren't willing to accept that new price. Now, the other thing about bond market, very similar to any other market, you economists say market, and this is just like any other market that will work, and that works the same, ceteris paribus. I slipped that in there. But ceteris paribus, when we talk about everything else held fixed, then we look at what are the determinants of why maybe these would not just the price moving up and down when changing quantity, but the entire graph or the entire line will move, the demand line. So we'll look at some of the determinants of why the supply curve or the demand curve will shift. And that's what I have here, some differences why they would shift. And I'm talking about shifting, not just going up and down. That would be a change in price. But when the whole line is going to shift one way or the other, that is a different mechanism. That's a third dimension. The two dimensions here are really interest rate and price are inverse of each other in the way the bonds are priced and how they are viewed. So the rate of return or the interest rate and the price are inversely related, so they're on the same, they're two different axes, but they describe the same thing. And then the quantity is here, so if there's a change, it's just going to go up and down one of these curves to get to meet back to that equilibrium point. But what I'm talking about now is why would they be moving? And that move of a significant change in the supply and demand curves will change that, make more of a permanent change in the price and interest rate. So if the wealth is going up, now wealth going up would mean that the that the value of the dollar is improving, that inflation is going down. We're at the, if we're talking about the business cycles, there's four parts of a business cycle. There's a peak, there's recession, there's a trough, and then there's recovery. And if we're approaching the peak, then there's an expansion of the economy. If the economy is expanding, then interest rates are, inflation's going down. If inflation's going down, then our price levels are going down. Then our value of the dollar, we feel more rich because we can buy more with the dollar than we could yesterday when the prices were higher. With the lower prices, then we feel more wealthy. Then when our wealth goes up, we also have more money to spend because we're spending less. Then we want to save more. A proportion of that would be more savings. If we're more savings, then we're going to insist or demand more of an asset. If the rate of return is going up, then higher rates mean that there are higher prices. So there'll be a lower quantity demanded with higher interest rates. So the asset would be a shift to the left. If there's wealth going up and we're at a peak or approaching a peak of the business cycle, the economy is expanding, then there's going to be a rightward shift of the demand curve. If the expectation of inflation is going up, then that means that price levels are going up. We feel less wealthy. We have to hold on to, or demand for money increases, demand for liquid money. So we want more cash because things are going up in price. We don't have the luxury of being able to save, because now we have to reduce our savings and increase our consumption, increase our spending. So savers will pull out of and demand less. That'll be a leftward shift of the demand curve when expectation of inflation is going up. If there's an increased risk level, whether it's an individual or in the bond market itself is looking that the bonds are becoming more risky, corporate bonds are more risky, then we'll have a less demand. There'll be a leftward shift in demand curve. And if there's if the liquidity or the ability to convert bonds to cash or convert that asset to cash is easier, because the activity is fast, we can easily jump in the market, get rid of the asset, convert it to cash, and walk away with some cash. If it becomes easier because of market activity, not because of any risk factor, but the market activity is higher, trades are more frequent, the frequency of trades inside the market at that particular time is higher, then you can jump in, get rid of an asset, and get cash back out. Then you're willing to turn that cash right away back into, or even hold on to that, invest, save in an asset that has a higher liquidity. Now, that's the demand side. If we look at the supply side, if that individual or that group or that industry is looking at profitability or increase in profit, then they're willing to supply more bonds or stocks into the marketplace. If and there's a higher expectation of inflation, then there's a higher expectation that you want to raise your interest rates. Raise the interest rate, because real interest rate would be going down if nominal minus expectation is equal to real interest rate. That's the Fisher effect. Fisher equation is that nominal interest rate minus inflation will give you the real interest rate, or what really the value of the money is that is paying out. If inflation is increasing, then there'll be a higher level of higher priced, more assets going out. And if there's government spending, I put it as a G because I'm basing it off of the Keynesian formula of the expenditure model of GDP. And G stands for the C plus I plus G plus NX, consumption plus business investment plus government spending plus net exports. And that G is the government spending. If the government increases spending, that would be a crowding out in the loanable funds market, which increases interest rates. If the interest rates are going up, price is going up, then there will be more of a quantity supplied, willing to supply at that higher interest rate. So those are some reasons why the demand curve looks the way it is. The market for bonds or stocks look the way it does. And this is I'll be very honest with you, this is a very simplistic model. It's a good idea, a way to wrap your mind around how it works, and it does work based on price and on inflation, an interest rate. So the combination of the two is how we look at, and how now we're going to talk about in the next week. We will talk about more in the valuation of these. Thank you. See you next time.